Silicon Valley, a junior engineer named Alan did something strange. He didn't analyze charts. He didn't read analyst reports. He spoke to a janitor. That janitor cleaned the office of a small, unknown company. One night, Alan heard him say, "They work like maniacs. Every screw, every line of code. They test it 3 times." Alan didn't ignore the comment. He listened, and he bought the company's stock. $10,000 turned into $7 million. The company? Amazon. What if I told you that wasn't luck? That it wasn't genius? It was something else entirely, something anyone could learn, but almost no one ever does. A nearly forgotten method taught by one of Warren Buffett's few teachers. A method that doesn't rely on spreadsheets, hype, or timing the market. His name was Philip Fisher, not a showman, not loud, barely photographed. Yet this quiet investor shaped generations. His technique, so invisible, so analog, so human. It's often ignored in today's algorithm-driven world. But if you understand it, you unlock a code. Because markets don't move because of data. They move because of people, their behaviors, their patterns, their whispers. The greatest market signals aren't found in a balance sheet. They're spoken in hallways, muttered over coffee machines, buried inside supplier warehouses. This is the world of Scuttlebutt, Philip Fisher's most legendary, yet criminally underused technique. It's like spycraft for the smart investor. Here's the truth. Most investors stare at data hoping to see the future, but data is past. What you need to know is what's happening right now inside the company. In the 1950s, when Motorola was just another name, Fisher wasn't reading headlines. He was interviewing vendors. He asked, "How do they treat you?" One vendor said, "They never accept good enough. It's always do it again. Better." That wasn't just a compliment. It was a signal. Fisher bought in. And as Motorola scaled the world, his investment exploded in value. Not because of PE ratios, but because he listened. Imagine you're curious about investing in a new AI chip maker. You check Reddit and find posts from ex-employees. Some say, "Toxic culture, everyone's leaving." Others write, "Best team I've worked with, obsessive focus on innovation." Then you hop over to Glassdoor. You notice they've been hiring aggressively. And on LinkedIn, their top engineers used to work at Nvidia, Tesla, and SpaceX. Now they're all here. Do you see what's happening? You're decoding the whisper. Because while others are drowning in macroeconomic predictions, you're zooming into micro-realities, truths only seen by those who ask. So here's your challenge. Pick one company you're interested in. Don't check the stock price. Instead, dig. What are customers really saying on forums? What if there was a checklist, 15 simple questions, that could predict whether a company would soar or silently rot from within? Philip Fisher created one. But it wasn't filled with technical ratios or economic forecasts. It was human, behavioral, alive. Each question peeled back a layer of the company's soul, exposing whether it was built for legacy or just survival. When he asked, "Does the company have a worthwhile R&D program?" he didn't want a yes. He wanted a story, a pattern, a culture. Let's decode how this works today. Imagine you're looking into a company like OpenAI in 2025. You could ask, are they innovating? Sure. But a deeper version is, are they innovating faster than competitors while maintaining safety, culture, and scale? Now you're in Fisher's realm. You can have the best product in the world, the biggest market, the strongest balance sheet. But if the people leading the company are weak, unethical, or just plain blind, none of it matters. So how do you know if leadership is solid? Fisher didn't care about titles. He cared about behavior. He asked, is management honest? Do they admit mistakes? Let's take a real story. In 2020, there was a promising fintech startup, flashy website, big investors, rocket ship valuation. But in interviews, the CEO often dodged questions. Fisher would have spotted it instantly. By 2022, the company collapsed. Why? Not because of the product, because of the person. Now contrast that with someone like Jensen Huang of Nvidia, soft-spoken, visionary, relentlessly long-term. In investor calls, he often discusses strategy 5 years ahead. Great companies are not monuments, they're organisms. And like all living things, they either evolve or they die. Fisher didn't just look for companies with great products. He looked for those with a built-in obsession for becoming better, faster, smarter. Think about BlackBerry, once a titan of mobile communication, secure, respected, untouchable, and yet, While Apple obsessed over touchscreen interfaces, BlackBerry was busy celebrating its existing customer base. Now flip the coin. Look at Nvidia. In the early 2000s, they were just another graphics card maker. Fast forward to 2025, they're powering AI revolutions. Innovation isn't about flashy moves. It's about asking uncomfortable questions. Does the company cannibalize its own best products before someone else does? Imagine a gleaming castle built on a hill, towers high, banners flying, but around it, no moat, no water, no walls, just open terrain. That castle might look mighty, but it's one sword away from being conquered. This is the metaphor Philip Fisher never stated, but always lived by. Take Apple. Its iPhone may be expensive, but people buy it anyway. Not because it's just a phone, but because they're locked into a world. There's a myth many investors fall for, especially when following the advice of long-term investing. They think once you find a great company, you can buy it, shut your laptop, and disappear into the mountains. But that's not what Philip Fisher taught. He believed in long-term investing, yes, but never in blind loyalty. His rule was simple: buy and hold, but only if you keep watching. Think of a gardener. You don't plant a rose bush and ignore it for 10 years. You water, you trim, you observe the soil. Want a modern example? Let's talk about Peloton. In 2020, it was the darling of pandemic-era fitness. Explosive growth, brand obsession, celebrity users. But by 2022, signs started showing: slowing user growth, supply chain chaos, and questionable leadership decisions. Investors who bought and walked away, they lost big. There's a myth in investing that the smartest move is always to hold. That selling is a form of weakness. That letting go means you were wrong. Fisher had only 3 reasons to sell. Just 3. First, you made a mistake. The company wasn't what you thought. Second, the company fundamentally deteriorated. Maybe leadership changed, culture eroded, margins shrank, innovation stopped. Third, you find a significantly better opportunity. Investing, after all, is about opportunity cost. If you discover a company that's growing faster, building stronger, innovating smarter, why keep your capital chained to yesterday's winner? In a world obsessed with perfect entry points and screaming buy signals, Philip Fisher offered a truth so simple it almost sounds boring. You can't time the market, but you can trust time. He didn't try to buy the bottom. He didn't sell the top. He bought great businesses when they made sense, and held them long enough for the magic of compounding to do what charts never could. Let's go back to 2005. A little-known stock called Amazon was trading under $50. Many passed on it. It wasn't profitable. Analysts were skeptical. But investors who believed in the vision, the leadership, the relentless reinvention, those who held, not for a quarter, but for a decade, saw it climb to over $3,000 by 2020. Here's the real wisdom bomb. Timing gives you a thrill, but time gives you wealth. One is a sugar rush. The other is a harvest. The most dangerous threats in investing don't come with alarms. They come quietly. A small change in customer sentiment. A shift in leadership tone. Let's go back to the story of Blockbuster. In 2000, they were untouchable. But if you paid attention, not to their numbers, but to their arrogance, you'd feel the tremor. They tell you to diversify, spread your bets, own a little of everything and you'll be safe. But Philip Fisher didn't buy that, not for a second. To him, over-diversification wasn't a safety net. It was a trap, a clever-sounding lie that diluted conviction and buried excellence under mediocrity. Think of it like a fire. Spread the flame across too much wood and it sputters. Concentrate it and it roars. Philip Fisher didn't wait for Wall Street approval. He didn't need headlines to confirm what he already felt in his gut. He was trained to spot what others ignored, tiny signals that hinted at massive future outcomes. A line buried in an annual report. A hiring trend no one's tracking. Take Netflix back in 2012. Their pivot to original content wasn't explosive. It started as a small mention in their earnings call. We're experimenting with in-house production. Products can be copied, features can be cloned, prices can be undercut. But there's one thing no competitor can steal: trust. Take Amazon. It didn't dominate because it was the cheapest. It won because people trusted it would deliver. Fast, easy, no questions asked. A company that stops growing doesn't die overnight. It stiffens, it stalls, it becomes a statue. Honored for what it was, irrelevant to what's next. Let's take Netflix again. First a DVD rental business, then a streaming service, then a production studio. Now a global content powerhouse. Philip Fisher didn't chase stocks. He chased clarity. In fact, if he couldn't explain a company's business model in a single breath, he didn't buy it. And here's the brutal truth. Most investors buy stocks they don't truly get. They follow trends. They mimic influencers. They believe in brands but ignore business models. Fisher had a rule: know the company better than most of its customers. He wanted to know how it made money, why people paid for it, what its risks were. There's a kind of wealth that doesn't shout. It waits, quietly, relentlessly. Philip Fisher mastered this art. He didn't pace the floor watching tickers. He didn't obsess over day-to-day price swings. Instead, he waited, because he knew something most investors forget. The market rewards conviction, but only when it's paired with time. Growth is seductive. A company reports 80% revenue jump. Headlines explode. Social media buzzes. Investors rush in. But Philip Fisher wasn't dazzled by numbers alone. To Fisher, not all growth was created equal. Some growth was structural, rooted in product-market fit, operational strength, and long-term demand. The rest, temporary blips. The greatest investor you'll ever have to outwit is you. Philip Fisher knew this. He understood that charts can't save you when your emotions revolt. The truth? Most portfolios don't die from bad businesses. They die from bad behavior, selling in panic, buying in euphoria, holding out of pride. The stock market is a seductive distraction. It blinks, it scrolls, it flashes red and green like a casino designed to hypnotize. Fisher didn't watch price action. He watched value creation. He wanted to know, are customers multiplying? Are margins improving? Is leadership making smart bets? The market will try to shake you, again and again. It will throw headlines like darts, blare expert opinions like sirens, and flood your feed with hot takes. Fisher didn't seek agreement. He didn't wait for CNBC to echo his moves. He trusted his process, even when it was lonely, especially when it was lonely. At the end of his life, Philip Fisher didn't leave behind a media empire. He didn't build a fund with his name on skyscrapers. He didn't chase fame. What he left behind was quieter and infinitely more powerful. A way of thinking, a lens for seeing the world, not just through stocks, but through wisdom. You've just journeyed through the mind of Philip Fisher, a man who never screamed for attention, never chased trends, never craved the spotlight. Yet his ideas shaped some of the world's greatest fortunes. Not because he offered hot stock tips, but because he taught us how to see. You now hold something rare, a new lens, a way of decoding greatness before the world recognizes it. A quiet advantage in a loud world, a discipline that protects you from noise, panic, and impulse. But knowledge only becomes power when it's used. Start here. Look at your current portfolio, not with the eyes of a trader, but through Fisher's lens. Ask, do I understand these businesses? Do they have moats? Do I trust the leadership? Are they becoming better or simply repeating themselves? If the answers don't bring clarity, maybe it's time to reframe, refocus, reallocate. Then, look ahead. The world is changing fast. AI, quantum tech, biotech, decentralized everything. The temptation to follow the crowd will be stronger than ever. But if you want to win, you must learn to see what the crowd cannot, to ask the questions they forget, to believe in your process when no one else does. And remember, investing isn't just about money, it's about how you think, your ability to stay calm under pressure, your skill in spotting truth in a sea of noise, your courage to wait when everyone else is rushing. That's what this channel is about. Not just finance, but mental frameworks. Not just strategies, but stories that shape your mind. So if this resonated with you, subscribe, comment, join the conversation. You're not alone in this. There's a tribe of thinkers who refuse to play the market's shallow game, and we're building it right here. In the comments, tell us, which chapter from Fisher struck you the hardest? What's one thing you'll do differently starting today? And one final truth to carry with you. The market rewards action, but it remembers conviction. Invest not just with money, but with meaning. Build not just wealth, but wisdom. Welcome to the channel. Subscribe if you want clarity in a noisy world. What you're about to learn won't just change the way you invest. It might just change the way you see everything. But it wasn't just a compliment. It was a signal. It meant this company didn't tolerate mediocrity. Fisher bought in. Because while others are drowning in macroeconomic predictions, you're zooming into micro-realities, truths only seen by those who ask. But Scuttlebutt is just the beginning, because even if you hear the right signal, you still need to ask the right questions to know if a company can grow. Fisher's 15-point list is like a master key. But here's the problem. Most people read it like a test. They want answers. But Fisher didn't use this like a test. He used it like a conversation. Each question wasn't about right or wrong. It was about depth. Let me repeat that. You're not just buying into a business model. You're buying into a personality. Would you trust this person to run your life savings in private? But here's where it gets scary. Most investors don't look beyond the press photos. They fall for hype, for image, for buzzwords. But Fisher trained himself to look past the presentation and into the patterns. He read interviews. He watched how executives handled bad news. He asked employees, "Do you trust your boss?" The answers told him more than any earnings report. Because here's the wisdom bomb. You're not just buying into a business model. You're buying into a personality. For him, innovation wasn't a bonus. It was survival instinct. But here's where most investors get fooled. Innovation isn't a press release. Real innovation is quiet, relentless, sometimes even invisible to the market, until it's too late to catch up. Fisher asked a simple question. What is the company doing now that it wasn't doing 5 years ago? If the answer was not much, he walked away. Because he knew, companies that stop evolving start eroding. Want another example? Look at Shopify. In 2014, they were an e-commerce builder. By 2021, they were integrating payments, logistics, capital, and now in 2025, AI-powered business ops for solopreneurs. That's not luck, that's engineered evolution. Fisher would call that a buy. Because here's the wisdom bomb. You're not just investing in what a company is. You're investing in what it's becoming. And the only way to know that is to study its hunger. Because companies that evolve survive market crashes. They survive media cycles. They even survive leadership mistakes. Why? Because their evolution is built into the DNA. iMessage, AirDrop, iCloud, AirPods. It's not just product, it's ecosystem gravity. Even when competitors offer better specs, Apple users stay. That's a moat. Now rewind to Netflix. In 2011, they faced a storm. Stock dropped. Competitors laughed. But what no one saw coming was their moat, content personalization. Years of user behavior data allowed them to tailor everything. Competitors had shows. Netflix had algorithms. Fisher would have seen it. He knew whoever builds deeper emotional roots wins the long game. Want a 2025 example? Look at Stripe. Competing in the brutal world of payments. But developers love it. Why? Because it works. Because support is real. Because they keep innovating while others copy. That love, that respect, it's not in their profit margin. It's in their moat. Ask yourself, are the companies you own protected by anything other than price? Because if they'd leave, so should you. Moats also evolve. What worked 10 years ago, like brand image, might not hold today if competitors close the experience gap. This is why Fisher watched moats like a hawk. He knew, strong today doesn't mean strong tomorrow. So, look closer. What invisible walls has a company built? What do they do that competitors can't or won't? What makes them untouchable? Because only with a real moat can a company survive storms, copycats, and economic shifts. And that moat is often the reason a company stays great long after the hype fades. Because even the best company can rot if you're not paying attention. Cultures shift, leadership weakens, competitors catch up. The very traits that made it great can fade quietly while you're busy being patient. And when you finally check back in, the moat is dry, the walls have cracked. Fisher's version of patience wasn't passive. It was alert. Think of a gardener. You don't plant a rose bush and ignore it for 10 years. You water, you trim, you observe the soil. That's how Fisher treated his investments, like living things that need tending, not stocks on autopilot. But those who watched closely saw the red flags and had time to act. On the flip side, take Microsoft. In the early 2010s, many thought they were done. Missed mobile, lacking innovation. But investors who stayed vigilant noticed something subtle. Their cloud division was growing. Satya Nadella stepped in. Culture shifted. Azure exploded. That wasn't a miracle. That was a company evolving under a watchful eye. Fisher would have smiled at that. Because for him, the question was never, is this company perfect? It was, is it still becoming better? If the answer stayed yes, he held on. If not, he didn't wait for the market to tell him. He moved. This is the wisdom bomb. Long-term investing only works when you stay emotionally short-term, meaning you remain sensitive, curious, willing to see things that no longer fit. Ask yourself, when was the last time you really checked in on the companies you own? Not the stock price, but the soul. Have they hired smarter, launched better, kept their promises? If not, maybe the rose is wilting, and you're pretending it still blooms. There's nothing wrong with holding for years, but it only works if you hold like Fisher did, with eyes wide open, ears on the ground, and your conviction constantly tested. Because investing isn't set and forget, it's set and stay sharp. But let's go even deeper. Sometimes, even after watching closely, you'll face a hard decision. He believed that knowing when to walk away is just as important as knowing when to buy, because the longer you hold on to the wrong thing, the more you lose. Not just money, but focus and conviction. Fisher had only 3 reasons to sell. Just 3. First, you made a mistake. The company wasn't what you thought. The management lied, or the moat was shallower than it appeared. When this happened, he didn't hesitate. He cut it, quickly, quietly, no drama. These shifts often happen slowly, like rust. You don't notice until the structure crumbles, but Fisher was trained to feel those early vibrations. And when he felt them, he didn't wait for proof. He moved. Third, you find a significantly better opportunity. Investing, after all, is about opportunity cost. If you discover a company that's growing faster, building stronger, innovating smarter, why keep your capital chained to yesterday's winner? Let's put this into story. Imagine you're holding shares in a once iconic retail company. In the past, it dominated, but lately, leadership changes every 6 months. Store traffic's down. No major innovation in years, but your ego says, hold, it'll bounce back. Meanwhile, there's a startup disrupting the same space, growing like wildfire, and you believe in their vision deeply. What would Fisher do? He'd thank the old company for its service and reallocate. Not emotionally, strategically. This is what separates professionals from gamblers. Professionals prune. They don't cling. Because every dollar you leave in a dying company is a dollar that could have bloomed elsewhere. Think about IBM in the 2010s. A titan, sure. But slowly, quietly, they missed the cloud. Amazon and Microsoft sprinted past. Investors who clung to the past missed the future. Fisher would have seen the writing on the wall, because he didn't marry stocks. He dated them, with standards. This is your mirror moment. Are you holding something because you love the company, or because you fear admitting you were wrong? What if the smartest move isn't to double down, but to let go? Selling isn't failure. Selling is discipline. It's how you stay light, how you pivot, how you respect your capital enough to only keep it where it grows. And once you understand this, investing becomes clearer. You're no longer chasing gains. You're managing a garden, planting where the sun shines, pruning where the roots decay, buying it at the wrong time. In the next chapter, we'll uncover why Philip Fisher never believed in timing the market, only in trusting time itself. He didn't try to buy the bottom. He didn't sell the top. He bought great businesses when they made sense, and held them long enough for the magic of compounding to do what charts never could. Here's the paradox. Most investors spend 90% of their energy trying to predict the unpredictable. Interest rates, inflation, earnings beats, geopolitical tensions. Fisher spent that same energy studying the only thing he could truly understand, the business itself. Because if the company is great, truly great, then time is your ally, not a threat. Fisher understood the danger of trying to outsmart short-term volatility. Because volatility is a feature, not a flaw. He didn't react to every dip. He saw them as discounts. He didn't panic during pullbacks. He prepared. Because he knew that if the business kept growing, time would reward his calm. Here's the real wisdom bomb. Timing gives you a thrill, but time gives you wealth. One is a sugar rush. The other is a harvest. In 2022, countless retail investors jumped into meme stocks, crypto trends, speculative SPACs, all hoping to catch a quick wave. And yes, some did, briefly. But most rode those waves straight into a crash. Why? Because timing is a game of luck wrapped in confidence. Fisher didn't play that game. He wasn't fast. He was accurate. He bought with intention and held with conviction. Want another example? Costco. Not flashy, not explosive, but consistent. Those who understood its flywheel, the membership model, the razor-thin margins, the scale efficiency, held through noise, and in return, steady compounding growth, year after year. This is your moment of reflection. Are you investing with a stopwatch or with a calendar? Do you chase the thrill of being early or the peace of being right? Because here's the secret. The greatest fortunes weren't made from perfect timing. They were made from imperfect timing, held long enough to become perfect outcomes. So next time you feel the urge to act, stop. Ask yourself, has the business changed or just the price? If it's just noise, let it pass. If it's signal, respond with strategy, not emotion. Fisher's legacy wasn't built on reaction. It was built on rhythm. A rhythm that trusted seasons, not seconds. But even time can't save you if you ignore what's happening around the castle walls. Because sometimes, a competitor sneaks in. A new product disrupts everything. A subtle change shifts the tide. That's why in the next chapter, we'll explore the art of active observation and how staying tuned to subtle shifts can help you defend your portfolio from silent threats. The most dangerous threats in investing don't come with alarms. A shift in leadership tone, a new competitor you've never heard of. Philip Fisher understood this better than anyone. That's why he warned investors, don't just buy and forget, buy and observe, because the storm that wrecks your portfolio doesn't look like a storm at first. It starts as a drizzle, a soft rain of missed expectations, unnoticed defections, delayed product launches. If you're watching, really watching, you'll see the shift long before the damage is done. In 2013, they made a controversial pivot, moving from selling software licenses to a subscription model. Critics panicked, but investors who stayed alert noticed something subtle. Recurring revenue was rising. Churn was low. User engagement was sticky. Fisher would have leaned in. Because he knew, innovation often looks like risk before it looks like brilliance. Here's the truth most won't tell you. You don't need to predict storms. You just need to notice the wind changing. In 2025, you have more tools than Fisher ever dreamed of. Google Trends, LinkedIn hiring spikes, Reddit threads, Glassdoor reviews, conference transcripts. These are your satellites, and yet, most investors still fly blind, checking price charts instead of reading human signals. Fisher trained himself to ask, what's changed that shouldn't have? If a company that's known for innovation suddenly goes quiet, that's a signal. If a team starts hiring more marketers than engineers, that's a clue. If customers start complaining, not about price, but about trust, that's a red flag. But this doesn't mean paranoia. It means awareness. It means creating a rhythm where you revisit your investments with fresh eyes. Not every week, but regularly, with discipline, with curiosity. You're not watching the stock. You're watching the soul of the business. Here's your mirror moment. Are you treating your portfolio like a museum or like a living system? When was the last time you really looked at your top holdings and asked, has something shifted? And what does it mean? Because companies don't collapse overnight. They erode, slowly, and only the alert investor catches it in time. Fisher wasn't fast. He was awake. While others slept in comfort, he listened. While others panicked at headlines, he watched for patterns. So, before you ride a company to zero, or sell too soon out of fear, pause, look deeper, ask better questions. You'll be shocked at what the world quietly tells you if you're willing to hear. And speaking of quiet signals, sometimes the most important sign isn't external, it's internal. It's the realization that you don't need 100 stocks to be safe. In fact, Fisher believed the opposite, which is why in the next chapter, we'll expose one of the biggest lies in modern investing, the myth of diversification. Because the more stocks you own, the harder it becomes to watch any of them well. And if you can't watch closely, you can't act wisely. Fisher didn't believe in owning the market. He believed in owning your best ideas, the companies you understand deeply. The ones you've researched, like your reputation, depended on it. Why scatter your energy across 50 average companies when you could concentrate it into 5 extraordinary ones? Think of it like a fire. Spread the flame across too much wood, and it sputters. Concentrate it, and it roars. Let's go to a modern example. Cathie Wood's ARK funds. At first, hailed as visionary, but soon, too many ideas, too little focus. Performance wavered. Now contrast that with Warren Buffett, who, like Fisher, often held just a few big bets with massive conviction. Apple, Coca-Cola, American Express. Not dozens, a few. watched obsessively. In 2025, this principle matters more than ever. With thousands of stocks, tokens, funds, and startups screaming for attention, most investors drown in options. But Fisher taught the opposite: narrow your focus to deepen your clarity. He believed that true security doesn't come from holding everything. It comes from understanding a few things deeply. That kind of understanding can't happen when you're juggling dozens of positions. It happens when you study, when you listen, when you're willing to say, "This is the company I'd stake my reputation on." But there's more to it. Over-diversification also kills accountability. If your portfolio is cluttered, it's easy to hide your mistakes. And yes, fewer positions means more volatility. But Fisher didn't fear volatility. He feared ignorance. Because drawdowns pass. But buying into things you don't understand? That damage sticks. Here's your mirror moment. How many stocks do you own right now that you couldn't explain in 5 sentences? How many are just there, placeholders, trends you followed but never truly believed in? What if the key to clarity wasn't adding more, but cutting back? What if mastery came not from managing everything, but from committing to the few things worth watching? This is what separates the noise chasers from the conviction builders. Fisher's approach wasn't popular then. It isn't popular now. But the results? They're timeless. Because in the end, it's not about owning the market. It's about owning the few others have. And you can only do that when your attention isn't scattered, but sharp, like a sniper, not a shotgun. But even a focused investor needs signals, subtle clues that something big is coming. And that's what we'll explore next. In the following chapter, you'll learn how to detect small clues that hide giant opportunities. The kind of whispers Fisher used to buy greatness long before the crowd ever noticed. Philip Fisher didn't wait for Wall Street approval. He didn't need headlines to confirm what he already felt in his gut. Why? Because he was trained to spot what others ignored. Tiny signals that hinted at massive future outcomes. A line buried in an annual report. A hiring trend no one's tracking. A change in tone from a product manager. These were Fisher's gold mines. He didn't chase hype. He hunted clues. He believed greatness doesn't announce itself with a megaphone. It slips into the room quietly, waiting for someone sharp enough to notice. And those who do, they get in early. They ride the wave before the world even knows there's a tide. Most ignored it. Fisher wouldn't have. He would have dug in, asked, why? What is that signal? Fast forward, that small experiment became a moat so strong, even Disney struggled to match it. Or Shopify. Before it became an e-commerce juggernaut, there were signs, small ones, a rise in developer job listings, community chatter about their API quality, merchants praising their support. To most, it looked like noise. To a trained eye, it was a chorus of coming dominance. Fisher trained himself to look for patterns in the margins, because truth lives there, off to the side, away from the main narrative. He'd read footnotes with more interest than headlines. He'd compare the language of last year's CEO letter with this year's. Was the tone bolder, more cautious? That's not semantics, that's signal. In today's world, we have even more access to these micro clues. LinkedIn hiring surges, patent filings, Glassdoor reviews. Sentiment shifts on forums. AI can scan the data, yes, but you still need the human instinct to feel the pattern behind the numbers. Here's the real chapter. Big moves rarely start big. They start with tension, with subtle change, with whispers. And the investor who can hear that before it becomes consensus, that's the one who captures exponential returns. So, how do you train that eye? You stop chasing. You start listening. You pick a company, study its behavior over time. Read every statement. Follow hiring moves. Watch user reviews evolve. Over time, you build a memory, a fingerprint of the company's soul. And when it shifts, this is your mirror moment. Have you ever looked back and thought, the signs were there, I just didn't see them? What if your next big investment isn't about what's popular, but about what's quietly unfolding? Fisher didn't need to be first. He needed to be early. And in investing, that distinction is everything. But there's one more layer to this, because even if you spot the signs, even if you understand the moat, trust the leadership, and believe in the mission, you still need one thing most investors never ask for: trust. Not in the company, in the customer. And that's exactly where we're going next. In the following chapter, we'll explore how trust, not trend, builds empires, and why companies that earn it are almost impossible to dethrone. Philip Fisher understood this before brand loyalty became a marketing buzzword. To him, trust wasn't just a soft asset, it was the foundation of every great business, because once a customer trusts you, they don't leave. Even when others offer more, even when things go wrong. That's not loyalty, that's emotional equity, and it compounds faster than revenue ever could. Fisher often asked one quiet question: do customers come back not because they have to, but because they want to? That single sentence exposed a company's real moat. It stripped away price wars and marketing spend, and forced a deeper reckoning. Has this company earned its place in the customer's life? Or consider Costco. They don't advertise, they don't chase trends, but customers trust that when they walk in, they're getting value, every time. That's why they stay, that's why they renew. Fisher would have called it business intimacy, and it's priceless. Now look at the flip side. Facebook, now Meta, has wrestled with public trust for years. Privacy scandals, data misuse. Fisher wouldn't have just looked at DAU numbers. He'd have asked, what happens when trust erodes but usage remains? That's not strength, that's addiction. And addiction doesn't build lasting love. It builds quiet resentment. Trust transforms customers into evangelists. It removes price sensitivity. It creates defenders during crises. And most importantly, it gives companies room to evolve. Because when people trust your intentions, they forgive your stumbles. Fisher knew this. That's why he didn't just look at financials. He looked at reputation. How did customers describe the brand when no one was watching? Were they just satisfied or emotionally invested? And today you can measure this in ways Fisher never could. Social listening tools, NPS scores, referral rates, organic word of mouth, customer retention curves. But you still need one thing he had in abundance: empathy, the ability to feel what the market feels before the numbers show it. So here's your mirror moment. Do the companies you invest in command trust or just attention? Are customers choosing them out of desire or habit? And if a new player offered something shinier tomorrow, would they stay? Because here's the bomb. Attention fades, but trust lingers. And in a noisy world, companies that earn belief rise above the static. Fisher didn't chase clicks, he chased conviction. And in doing so, he taught us a secret. Businesses don't scale because of what they sell. They scale because of what they mean to people. But trust is only part of the equation, because even the most beloved companies need to reinvent themselves to survive. That's why in the next chapter, we'll explore Fisher's obsession with evolution and how he identified companies that were always becoming something more than what they seemed. Fisher feared this more than bad earnings or market downturns, because to him, the greatest risk wasn't decline, it was stagnation. That's why he didn't just ask, what is this company today? He asked, what is this company becoming? Fisher believed the best businesses are never done. They evolve, they stretch, they challenge their own identity. The moment a company becomes satisfied, it begins to rot. Because they knew, if you don't disrupt yourself, someone else will. Fisher didn't need to see subscriber growth. He would have seen the mindset, and that was enough. Or look at Nvidia, once just a chip maker, then a gaming accelerator, now the backbone of AI infrastructure. They could have coasted, but instead, they redefined their playing field. Fisher would have seen the clues years ago. Aggressive R&D, talent acquisition, visionary roadmaps. He would have said, this company isn't resting, it's becoming. Here's the secret. Great companies treat success like an invitation, not a destination. They don't protect their past. They prepare for a future that doesn't exist yet. Fisher hunted for this kind of restlessness, this creative paranoia. But how do you spot it? You listen, you watch. Is leadership talking about the next decade or just the next quarter? Is the company investing in bold bets, even when the current model works just fine? Are they hiring for skills the market hasn't caught on to yet? It's subtle, and that's why most investors miss it. They want proof. Fisher wanted patterns. And let's be clear, becoming doesn't always mean pivoting. Sometimes it means deepening. Shopify, for example, didn't abandon its core. It expanded it, layering tools, infrastructure, capital, and AI to turn small sellers into empowered businesses. That's not just scaling, that's becoming an ecosystem. This is your mirror moment. Are you investing in companies because of what they are, or because of what they're capable of becoming? Do you see their next chapter, or are you stuck in their last one? Fisher never invested in a snapshot. He invested in a film reel, one with motion, momentum, and mystery. And there's one more thing. Companies that are always becoming, they make mistakes, big ones. But they survive because they're alive. They adapt. They learn. They're not fragile. They're fluid. In the end, Fisher's question wasn't, how is the company performing? It was, is the company still becoming? If yes, he held. If no, he moved on. But even becoming isn't enough if the company's foundation is built on shaky understanding. Because in the next chapter, we'll turn inward. Fisher didn't just demand companies evolve, he demanded the same of you. It's time to explore why understanding what you own is the ultimate edge, and why ignorance is the costliest risk of all. And here's the brutal truth. Most investors buy stocks they don't truly get. They follow trends. They mimic influencers. They believe in brands but ignore business models. And then, when the market turns, they panic, because they never really knew what they owned in the first place. This principle is more important than ever in 2025. Today's market is flooded with innovation. Biotech, quantum computing, decentralized finance, AI infrastructure. The temptation is to get in early, but if you don't understand the mechanism, the ecosystem, the revenue drivers, you're not investing. You're gambling in a language you don't speak. Remember the SPAC boom of 2021? Dozens of pre-revenue companies with bold visions, electric vehicle makers, space tech startups, metaverse plays. Most investors didn't understand what these companies actually did, only what they promised. And when the excitement dried up, so did their portfolios. Fisher avoided that trap. If he didn't understand the business, he didn't touch it. No exceptions. And here's the bomb. Understanding creates emotional stability. When you know how a company works, you're not shaken by temporary price dips. You don't flinch at earnings volatility. You don't follow the herd, because your conviction is rooted in comprehension. Let's flip this into story. A young investor in 2018 was obsessed with biotech. He bought into 3 promising gene therapy startups. But when the market dipped, he panicked, because he never really understood clinical trial pipelines, FDA hurdles, or cash burn rates. Meanwhile, his friend held on to Adobe. Boring, maybe, but she understood their subscription model, their market dominance, their competitive edge. Guess who slept better? Fisher believed that ignorance is the most expensive asset you can hold, and in investing, it's rarely priced in, until it's too late. This is your mirror moment. Could you stand in front of a whiteboard and explain, clearly, confidently, why each company in your portfolio deserves your capital? Or are you hoping someone smarter did that work for you? Because Fisher didn't outsource his understanding. He built it, brick by brick. And once you master this lens, once you commit to knowing fewer companies, but knowing them deeply, you stop reacting. You start thinking. You stop chasing. You start choosing. But there's another layer. Because even when you understand the business, the market doesn't always reward you immediately. The price might not move. The world might not agree. And that's when most people quit. But Fisher had an antidote to this too. In the next chapter, we'll explore the final unshakable advantage of the uncommon investor, the strategic patience to wait, quietly, confidently, and relentlessly, until the rest of the world catches up. There's a kind of wealth that doesn't shout. It waits, quietly, relentlessly. Philip Fisher mastered this art. He didn't pace the floor, watching tickers. He didn't obsess over day-to-day price swings. Instead, he waited, because he knew something most investors forget. The market rewards conviction, but only when it's paired with time. Fisher's greatest advantage wasn't intellect. It was patience. Strategic, intentional, almost meditative patience. He understood that businesses, real, great businesses, don't flourish on Wall Street's schedule. They need time to build, to iterate, to compound. And the investor who forces the process, they ruin the outcome. Think of planting bamboo. For years, nothing appears above the soil. It looks like a failure. But underground, roots are spreading, deepening, strengthening. Then, one year, it erupts, growing feet per day. Fisher invested like that. He bought when the world was quiet. He held when the market was impatient. And when the time was right, he harvested what others couldn't even see. But the patient few who understood the scale of its ambition and were willing to endure the volatility were rewarded with generational returns. But patience isn't passive. Fisher didn't sit still. He observed. He listened. He verified that the company was still becoming, still growing, still aligned with his original thesis. He didn't wait out of laziness. He waited out of alignment. here's the real chapter. Patience isn't about doing nothing. It's about doing the right thing, long enough for it to work. That's the fatal flaw in modern investing. Everyone wants results now. Quick wins, instant gratification. But greatness takes time. Compounding takes time. Reputation, trust, innovation, all of it demands time. And when you're impatient, you pay a premium. You buy late. You sell early. You move when you should hold. You react instead of responding. Fisher's patience wasn't a personality trait. It was a strategic decision. He chose to wait for results, even when the market called him wrong. And that's what made him right. So here's your mirror moment. Are you building a portfolio, or are you building a story you're not willing to finish? And only those who pass that test experience the kind of returns that don't just change portfolios. They change lives. Fisher knew this. That's why his positions sometimes lasted decades. Because he understood, if the business is great, if the vision is clear, and if the path is unfolding, time isn't your risk, it's your edge. But even time needs guidance, because not all motion is progress. And that's why, in the next chapter, we'll uncover how Fisher separated real growth from artificial shine, and how you can tell whether a company's momentum is meaningful or just marketing. At the end of his life, Philip Fisher didn't leave behind a media empire. He didn't build a fund with his name on skyscrapers. He didn't chase fame. What he left behind was quieter and infinitely more powerful, a way of thinking, a lens for seeing the world, not just through stocks, but through wisdom. And in that silence, he built a legacy louder than any headline. Fisher wasn't obsessed with beating the market. He was obsessed with understanding it. He didn't chase wealth. He pursued clarity. And through that clarity, wealth followed. But more than money, what he gave to those who studied him was a compass, a way to move through chaos with calm, through noise with chapter, through pressure with poise. Because Fisher knew the market is a mirror. It reflects not just businesses, but beliefs. Your beliefs, your fears, your instincts. And unless you learn to master those, you'll spend your life reacting instead of building. His legacy wasn't in picking the perfect stock. It was in choosing the right approach. One rooted in deep research, one unshaken by volatility, one immune to hype, a style of investing that didn't scream. It whispered, observed, waited, and moved when it mattered. That's why Warren Buffett, one of the most public investors in the world, still calls Fisher one of his greatest influences. Because Buffett didn't just borrow his methods, he absorbed his mindset. The mindset of looking at businesses like living organisms. The mindset of asking questions others ignored, the mindset of discipline over drama, and that's what you now carry. After these chapters, you're not just someone who reads market news. You're someone who listens for signals, who asks better questions, who sees beyond the ticker, who knows the difference between a good story and a great company. Fisher's teachings are timeless because they are human. They remind us that investing isn't just a financial pursuit, it's a philosophical one, about who we are when challenged, about what we trust when doubt creeps in, about how we behave when no one's watching. So, here's your final mirror moment. What kind of investor do you want to become? Not just in returns, but in mindset. Are you building a portfolio or a philosophy? Fisher's greatest gift was not just teaching people how to pick stocks. It was showing them how to think long after the stock was picked. And if you can carry that with you, through bull markets and bear winters, through noise and silence, then you've already won. Because you're no longer following the market. You've become the kind of investor the market eventually follows. You've just journeyed through the mind of Philip Fisher, a man who never screamed for attention, never chased trends, never craved the spotlight. Yet his ideas shaped some of the world's greatest fortunes, not because he offered hot stock tips, but because he taught us how to see. You now hold something rare, a new lens, a way of decoding greatness before the world recognizes it. A quiet advantage in a loud world, a discipline that protects you from noise, panic, and impulse. But knowledge only becomes power when it's used. So the question is, what will you do with this new vision? Start here. Look at your current portfolio, not with the eyes of a trader, but through Fisher's lens. Ask, do I understand these businesses? Do they have moats? Do I trust the leadership? Are they becoming better or simply repeating themselves? If the answers don't bring clarity, maybe it's time to reframe, refocus, reallocate. Then, look ahead. The world is changing fast. AI, quantum tech, biotech, decentralized everything. The temptation to follow the crowd will be stronger than ever. But if you want to win, you must learn to see what the crowd cannot, to ask the questions they forget, to believe in your process when no one else does. And remember, investing isn't just about money, it's about how you think, your ability to stay calm under pressure, your skill in spotting truth in a sea of noise, your courage to wait when everyone else is rushing. That's what this channel is about. Not just finance, but mental frameworks. Not just strategies, but stories that shape your mind. So if this resonated with you, subscribe, comment, join the conversation. You're not alone in this. There's a tribe of thinkers who refuse to play the market's shallow game, and we're building it right here. In the comments, tell us, which chapter from Fisher struck you the hardest? What's one thing you'll do differently starting today? And one final truth to carry with you. The market rewards action, but it remembers conviction. Invest not just with money, but with meaning. Build not just wealth, but wisdom. Welcome to the channel. Subscribe if you want clarity in a noisy world.